Good morning, Gerard. So IPF released its half-year results for 2016. How would you summarise the group's performance during the first 6 months?
Well, for the first half of the year, we delivered a profit of 30.7 million. Now, clearly, that's down significantly on the prior year, but it's down because of expected variances in our operations. And in particular, I'd just like to highlight a few. So first of all, in Poland, we had completely new regulation that has had a significant impact on the business. The second thing is we took a really difficult decision to exit our really good business in Slovakia because of regulation there. So those were two negatives that are included in the results. Now, there are two other negatives, but they're really positives for the long term. And that is we invested a lot of money in IPF Digital and in Mexico because the long-term potential in each of those businesses is tremendous. So those were the events that caused the profit to drop. And then there were two other variances, which I would say were unexpected. One is a significant outperformance in Southern Europe, and we were really very pleased with the results there. And the second was a significant underperformance in Mexico, and we can talk more about that in a second. So as I look at the first 6 months as a whole, I would say the results were okay, but with the exception of the performance in Mexico, which clearly we need to address. In terms of the long term for the business, the opportunities are still there. We just need to get back to growth mode in Mexico.
Can I ask what you're doing to improve the short-term performance in Mexico, but also capture the long-term potential in this market?
Well, I've been to Mexico every 8 weeks this year, and I was there just a couple of weeks ago to meet with Robert and his team to discuss the performance issues. And you know, it's clear to us the real drivers of the issues there are internal. Now, there are some external factors, but really in terms of the overall context, it's the internal drivers. And so what we've said is that we believe it's down to too much leadership stretch as we grew the business. The second thing is that we introduced a lot of change because the business is becoming larger and more complex. We've introduced new products, new distribution channels, and so on. And then the final piece was we had some issues in terms of execution in the field. Now, the good thing is, having done that whole diagnostic, we're completely happy with the plan that we have in place to turn that around. But this is a business that relies on 12,000 people to drive it forward, so it takes some time. But as I said, having spent a lot of time over there this year, I'm confident that Robert and his team have the right things in place to turn it around. So we're not going to open any new branches for the remainder of the year. We're not going to introduce any new organizational design changes or new products into the business. And we're going to take some of the experienced resource that we had previously taken out of Home Credit and put it back in to drive the overall performance of the business. So when we put all of those things together, I think we will return to short-term growth, and that is a precursor to longer-term growth, which we think is definitely available to us in the market.
You mentioned in your announcement that the business is undergoing significant change. Can you elaborate on what change you're driving?
Sure. Well, when we did our annual results earlier in the year, we explained that we were going to look at the business differently. So we split the business into what we called established markets and then growth markets. So now as we think about the business going forward, that's how we view it. So in terms of our established markets, really what we're doing there was we're going to sweat those businesses. And by that I mean we're going to make them more efficient. Now, there is still growth available in those markets, but it would be in the low single digit rather than the double digit type of growth. So what we really want to do is we want to use technology to take out manual roles. We want to use technology to drive overall efficiency and effectiveness in the business. And we're also investing a lot in a new set of technology for our field sales force, so our 28,000 agents. And that really will make a tremendous difference to the business. So those established businesses, we're looking for better performance in terms of cost effectiveness, maintain the quality of the portfolio, and take growth wherever it's available. In terms of the growth businesses, well, there we're talking about IPF Digital, Mexico, and Romania, Bulgaria. So IPF Digital is really a tremendous opportunity for us because of customer preferences moving more towards digital when they have a strong enough credit profile to get a remote loan. So our businesses in digital that have been around for some years are doing tremendously well. So they're growing top line and growing profitability. The only exception is Lithuania, where the overall market shrank because of new regulation. And then within IPF Digital, you have new, what we would call growth markets themselves, and they would be Poland, Australia, and Spain. Now, we're already serving 27,000 customers in those countries, and we think there's a huge amount to go after. I'm also delighted to say that within a matter of weeks, we expect to open our new digital business in Mexico. Now, this is going to be slightly different to other digital businesses because Mexico is different. And by that, I mean bank account penetration in Mexico is lower than in Europe. The cost of using internet is higher, and there is a slightly higher propensity for fraud. But we have tremendous experience from our Provident business there, and we'll use that to start cautiously and build from there. So, as I said, 27,000 customers in digital and growing really nicely. Mexico, we've already mentioned, we need to get it back on growth track, and I think we have the right plans to do that. And then finally, we have Romania, Bulgaria, and Romania as part of Southern Europe is doing tremendously well. So in terms of those growth businesses, feeling positive, notwithstanding the hiccup that we've seen in Mexico. Then finally, in terms of our businesses overall, I'm looking for us to be able to use the unique opportunity we have, and that is that we are the only business who can offer an agent-offered loan or a digital loan. Now, both we and our other digital competitors on the digital side reject anything from about 70 or 80% of all applicants coming through for a remote loan. For other competitors, they reject and forget about those consumers. For us, we have a tremendous opportunity in that we can say to those customers that we reject for digital, come and have an agent loan with us. Now, currently that whole operation for us is manual, but we're looking to digitize that over the coming months. So we think there's a great opportunity there for further growth as well.
And what's the outlook for the rest of 2016?
Well, I think there are a number of key areas that we need to focus on. First and foremost, we need to ensure that Poland comes through this new regulation in good shape. And I think the early indicators are positive because we're tracking for the projections that we previously put out. So I'm pleased with that. The next key thing is, as I said earlier, we need to make sure Mexico gets back to growth mode. And based on the plans that the business has in place, I'm confident we will do that in the second half of the year. Czech Republic needs to be stabilized. Now, our local management team there are reasonably confident by the end of the year we will achieve that. And then finally, Southern Europe and IPF Digital. Just continue that growth trajectory we've seen over the last 6 to 9 months, and we'll be in good shape. So as we look forward, I would say I'm optimistic in terms of the opportunities, but there are a number of big things that we need to make sure happen, and we're focused on that at the moment.
Gerard Ryan, Chief Executive Officer, thank you very much for your time.
Thank you.
So we just heard from Gerard about the group delivering strong growth across Southern Europe and IPF Digital, but falling short of expectations in Mexico. Can you tell me about the key drivers?
So we reported a profit of £30.7 million, and within that we saw underlying profit go down by £9.7 million, and that was in line with our expectations. We also had a benefit from weaker sterling during the course of the 6 months, so that helped us by £1.8 million. And we saw some investment into our new digital businesses of £4.7 million. So together that made up the overall change in profit. In terms of the individual constituents, we saw our credit issued amount go up by 6% compared to last year. We saw an increase of customer numbers by 1%. We saw good performance in relation to impairment as a total. It's at the lower end of our range and came in at 25.9%. We've also taken strong action on costs in the first half of this year and have taken out an annualised level of £12 million from our cost base. We will see most of the benefit of that in the second half of this year and into 2017, and that will continue as we move forward.
Can you tell me more about the strong performance across Southern Europe and IPF Digital?
So in Southern Europe, what we saw was some very significant growth in that market. So we saw profit grow from £6.9 million to £13.4 million. That's an underlying profit growth, once we strip out FX, of 81%. Now that was driven not only by growth in credit issued and customer numbers, but also by good collections performance. As regards credit issued, we saw strong double-digit growth in all 3 markets that make up Southern Europe, a total of 22% growth in credit issued. We saw good collections performance, which led to a reduction in impairment, and that level came down by 2.6 percentage points to 20%. So overall, a very pleasing performance in Southern Europe. So in relation to IPF Digital, this is a strong growth opportunity for us, and we saw some significant growth in the first half. We have both established markets and new markets. What we saw was customer numbers grow by 50% to 157,000. We saw credit issue growth of 55%, and we had revenue growth of 42%. So very strong growth in all of the top line measures. We saw impairment more or less where we would like it to be. The mix of new and repeat business brought impairment in at 32.6%, and that is within the range that we would expect to see for that business at that time. So overall, a very good performance from IPF Digital.
So what are your plans to deliver further returns to the shareholders?
So we're very well funded. We have a strong balance sheet. We have £160 million of headroom, and we have no significant funding needs in the near future. We have got a nice mix of sources of funding, and most of those, the majority of those funds, do not fall due for maturity until the next decade. We see no significant impact from Brexit other than the possible impact on exchange rates as a result of weaker sterling, because most of our operations are outside of the UK zone and most of our funding is outside of the UK zone, so we're okay from that perspective. Our equity to receivables ratio came in at 43.6%. Again, that is well within where we would expect it to be, given that our receivables growth was slightly lower in the first half. And we're maintaining our interim dividend at 4.6 pence per share.
Adrian Gardner, Chief Financial Officer, thank you.
Thank you.